Okay, so we're looking at the statement of retained earnings here, also called the statement of equity or statement of owner's equity. So again, pay attention to the first three rows. We have the name of the company, we have the nature of the financial statement, and once again, the statement of retained earnings, it covers a period of time, right? So this is all going to change when we look at the balance sheet, but remember that both the income statement and the statement of retained earnings both cover a period of time. So once again, we're looking at years. One year ended December 31st, 2018, and the latest year ended December 31st, 2019. So starting with 2018 again, we will have a retained earning balance, and recall that this is the accumulation of profits and losses since the inception of the company or business. So we have 940 sitting in that bucket, and we added on the net income of last year. So we're going to do the same thing for 2019. So we're going to see that the bucket is now 1300, and I'll talk a little bit more about where that number comes from, but for now we're just going to go ahead and plug in right in our net income from our income statement of $750. Then we have dividends. So if you recall, 20% of the income is paid out as dividends, and this comes out of retained earnings. So earlier in this set of notes, we saw when we pay out dividends, it reduces the equity. So more specifically, it reduces the retained earning balance. So we have 750 in 2019, and we pay out 150 to a dividend to shareholders, and we're going to end up with the year-end balance of 1900. So we started with 1300. The net increase for the year is 600. And again, this is all in thousands of dollars, so it's actually 1.9 million that we end up with. Now, I said I would talk about where the beginning balance came from in 2019, up here, and it's coming from the ending balance of 2018. So whatever we end with in our last reporting is what we start with in our next one. So the statement of retained earnings is best described as a glimpse into what a business does with its income. Let's analyze some elements of the table above. So the net income is carried from the income statement to the statement of retained earnings. As mentioned earlier, this explanation of financial statement is in order of data flow. So we make the income statement first, and we pluck a number out of the bottom there and put it into the statement of retained earnings. In both 2018 and 2019 above, we add our net income of the respective year to the retained earning beginning balance, and then deduct the 20% dividend that's being paid out to shareholders. This allows us to calculate the ending balance. The ending balance of 2018, the beginning balance of 2019, this will be a common occurrence in this course, with account balances which are carried forward from one year or quarter to the next. Hence, we can view the beginning balance of 2019 as a total net income earned in the past years, which wasn't paid out to shareholders as dividends or other distribution. One point to keep in mind is the current retained earning balance of any firm is net of any losses incurred in past years. So yes, if you only have losses, your retained earning balance can be negative. So it has a debit balance instead of a credit balance. It's negative equity. Therefore, if a firm only has net losses in its history, the retained earning balance will be negative. Next, we're going to look at the balance sheet. The balance sheet is best described as a snapshot of a company's assets, liabilities, and equities at a certain point in time. Note the title includes a specific date instead of a period, like the other financial statement. So at the top here, you can see the familiar three lines. You see the title of the company or business. Then you have the balance sheet. That's the nature of the financial statement. And the big change is in line 3 here. So instead of having for the year ended, blah, 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 we now have just two dates, December 31st, 2018 and December 31st, 2019. So it really is a snapshot. You're just taking a picture on one specific day, in this case at the end of the year, to show the external users of the financial statement what's happening inside the company. So we can see how much cash does the company have at this point in time, how much liability does it have, what assets is it holding. So all these are important things. So once again, have a look at 2018 side first. We have some short-term assets and they call current assets. So these are, generally speaking, assets which are expected to be converted to cash fairly quickly, or they're expected to be used up fairly quickly. So cash, of course, is the most liquid asset. We write that one first. An accounts receivable, we talked about this earlier, is when someone owes us money and we can expect to collect in the near future. That's accounts receivable. Inventory are items which we buy and hopefully sell for more. So in the case of the bookstore, they'll have a bunch of books and they have office supplies, which they hold for customers to come in and buy from them. So we add up the current assets, we get $6 million here. And then we have fixed assets. These are bigger, bulkier items, which are harder to convert to cash. And often you lose money trying to convert them on a short-term basis, right? So think of something like a building and land. If you were to sell that today in a real hurry, you probably wouldn't get the best price for it. So we have $3 million of furniture and then 800 of accumulated depreciation furniture. So what that means is the amount of wear and tear on the furniture. We'll talk more about depreciation later in the course. And we have the net value, book value. So 3,000 what we paid for it, that's historical cost, minus 800 what we've written down, we have 2.2 million left over. Same thing with equipment, right? So we have some IT equipment that helps us troubleshoot laptops. So 5 million worth of equipment, 440,000 depreciated. We're left with 4,560. That's a million for 4.56 million. Total assets, 12.76 million. And as I mentioned, assets is one half of the balance sheet. So when you add up all our assets, we have a kind of a final number here, a dollar sign, double underline, right? Same with a dollar sign at the top, as you saw on the income statement. And we go on to the liabilities and shareholders' equity section. Accounts payable, money which we owe to other people. The bank loan, this is like a formal money we borrowed from the bank. So when we add these two liabilities together, we get 5.86 million. And we have, in the equity section, we have some common shares, which is investment people have put into the company. And we have our 1,300 number here again, which is the total profit that we've earned over the years. We add those together, we get 6.9 million. And when we add liabilities and equity together, surprise, surprise, we get the same number as we had with total assets, which is 12.76 million. So that's how the balance sheet looked like. Let's pause here so you can work on the 2019 year, and I'll see you in the next video.